Welcome to our discussion on the third and final family of explanations for the business cycle. Explanations based on the ways that financial behavior by self-interested individuals can result in overall financial instability. Capitalist economies are monetary economies, and the ways that people decide to hold money can shape macroeconomic outcomes, as we just discussed in the last video about aggregate demand. But capitalist economies are also financial economies. They involve enterprises or investors buying assets, which they hope will generate gains, both flows of cash or cash flows, and capital gains or appreciations in price. The assets may be real, like production equipment, but they also may be things like a patent, a financial asset like stocks or real estate. Now, to purchase those assets, enterprises and individuals typically have to gather support from other people like investors or banks. This is done with financial contracts like loans, bonds, shares, equity stakes, and mortgages. Those contracts stipulate how much each investor contributes and the ways in which they will potentially receive a return. Those contracts are liabilities for the enterprise or the individual who is acquiring the assets. Now, the ways that enterprises and individuals behave when it comes to assets and liabilities, and the functioning of the markets where those assets and liabilities trade, those are all sources of potential instability in capitalist economies. Why? Because riskier behavior when it comes to how you finance investment and more speculative behavior betting on increases in the price of assets people are buying are often more profitable to the enterprises and individuals involved. Instability can develop when the success by some agents in generating high returns by engaging in risky financing or speculative behavior prompts other people to try to do the same thing. Why? Because the only thing worse than not getting rich is not getting rich while everybody else is getting rich. Risky behavior can spread like an epidemic as a result, creating conditions where the risks that investors are facing actually grows over time until you have a financial crisis. American economist Hyman Minsky made a key contribution along these lines. He identified three different kinds of financing and investment behavior or structures: hedge, speculative, and Ponzi financing. Hedge financing involves borrowing to buy assets that are expected to generate cash flows that will allow you to pay back interest and principal on the loan. As long as the asset doesn't disappoint, that's pretty safe, that's pretty straightforward. Now, speculative financing involves borrowing to buy an asset that you're expecting will generate enough cash flows to pay interest, but not enough cash flows to pay down the principal. A good example is borrowing to buy a housing unit to rent it out when the rent payments are going to be roughly around the same as your interest payments on the loan. This is speculative because the only motivation for doing this operation is the hope that the price of the asset will go up. The cash flows coming in are equal to the cash flows going out, and you're not paying down the loan. But if the asset appreciates, you gain net worth. Once you're in this position, you face two kinds of risk. First, asset prices may not increase. In fact, they may even fall and result in a loss of your net worth. The second risk that you face is that at some point you're going to have to refinance your position. That exposes you to the risk that rates of interest will go up. If they go up, the cash flows that the asset is generating will no longer be enough to make interest payments, and you're going to have a problem. The last financial structure that Minsky considered was Ponzi financing. Ponzi financing involves borrowing to acquire an asset that is not expected to generate enough cash flow to pay either interest or principal. The hope is that the asset will appreciate significantly after you buy it, generating capital gains that will make the entire operation worth your while. Minsky's argument is that the financial cycle happens because if you start from a safe situation where most financial structures are hedged, that situation ensures that some speculative units may become profitable by engaging in riskier financial behavior. The success of those units may induce other units to engage in riskier financial structures to chase higher profits, increasing the potential for instability in the system as a whole. Stability is destabilizing, as Minsky put it. The process can continue as the search for yield pushes units into Ponzi finance, up to a point where enough units can no longer meet their debt payments, triggering a credit crisis. People like Kindleberger and Schiller have told a similar story about speculation and asset prices. If some people make gains from increases in the price of an asset, that may induce others to buy assets of that kind in the hope of making the same gains. That is in itself enough to generate capital gains for people holding the asset. Why? Because as more people demand the asset, its price increases. Now, this appears to validate the actions of those who join the speculative buying, which in turn prompts even more people to do the same thing as well. The belief that this will continue forever takes over like a disease, spreading to millions of people, despite the evidence that things will end in tears. This time is different, everybody starts saying. There's something fundamentally transformative of different about this asset. You may be talking about tulips in Holland, investment trusts in the 1920s, dot-com tech stocks in the late 1990s, housing in the 2000s, and more recently, anything crypto. The search for individual returns destabilizes because for some time, that search is enough to validate itself, as long as new people buy into the speculative mania. Even when the risks start to become obvious for some people in the system, the lure of profits is enough to keep them betting on the bubble. The CEO for Citi, Chuck Prince III, put it very, very well on the eve of the 2008 financial crisis. He said, "When the music stops in terms of liquidity, things will get complicated. But as long as the music is playing, you've got to get up and dance." We're still dancing. Now, at some point, asset prices invariably collapse. And that does more than just destroy the speculative buying that have been sustaining their rise. It also ensures that many people who had borrowed in order to buy into the bubble are no longer able to pay back their loans. That in turn forces them to sell the asset, putting even greater downward pressure on prices. That's what Irving Fisher called debt deflation. The banks who have been lending to support speculation may fail because those loans are not being paid back, triggering a general banking and financial crisis. The crash of 2007 and 2008, when the United States financial system nearly imploded, may have been the most spectacular instance of processes of this kind. Its aftermath was devastating for millions of families, both those who lost their homes and those who lost jobs and businesses in the recession that followed. In this lesson, we looked at different ways that self-interested individuals looking for profits can set into motion destabilizing processes in credit and financial markets. Now that we've looked at the main explanations for the business cycle, we will now turn to possible interventions that society can pursue to mitigate those crises.